Dear ACCA student, I'm Eunice Xu. Nice to greet you here. Today, I would like to do some past paper review of strategic business reporting with you. I wish that will help you. Thank you.
Hello everyone, I am Eunice Xu, Head of Policy of ACCA Hong Kong. Today, I would like to share with you a past paper review in Question 1, Part A, September 2018. And this time, I would like to discuss equity accounting and loss of control. Let's take a look at the question. It is asking why we need to equity account for Strawberry up to the day of disposal and show the carrying amount of investment in Strawberry by the time of disposal. 4 marks. Now please be careful. This 4 marks is asking 2 items. First of all, why? Why we need to equity account in Strawberry? Secondly, what is the carrying amount of investment by the time when we dispose Strawberry? Now let's go into the question. It mentioned that a holding company acquired Strawberry many years ago, 40%, at a cost of 18 million. At that time, the fair value of the asset of Strawberry was 44 million. 44 million at the time. And the parent company has a right to appoint 1 out of 5 directors. Now we understand that if I'm able to appoint 1 out of the 5 directors, while the shareholding is actually above 20%, we can presume that there is significant influence. By significant influence, we means that the parent company has a right to participate in the finance and operating policy making. And on the 1st October 2016, Banana, the parent company, sold 75% of its total 40% shareholding. Now, out of the 40, you sell 75%. And at that time, the net asset value of Strawberry was 50 million. Now, let's forget about the disposal for the time being. Let's look at the time when the net asset value of the subsidiary was disposed. It's 50 million. Compared to the net asset value by the time when this subsidiary was first acquired a few years back, 44, the post-acquisition profit would be 6 million. That means during these few years, the subsidiary earns a profit of 6 million, and the parent company holds 40% of it. Therefore, the parent company shares 40% of these 6 million, equal to 2.4. And for equity accounting, given this subsidiary given this Strawberry is significant influenced, therefore the equity accounting entry will be debit investment in Strawberry, 2.4, and credit to P&L share of a sold profit, 2.4. Now we can explain a little bit why we have to equity account for Strawberry. Because if an entity holds 20% or more the voting right, we can presume that it has significant influence unless it demonstrates otherwise. Given it is 20% or above, it is actually below 50, therefore we cannot conclude that there is control. But above 20%, we can assume that. And this assumption is further confirmed by it has a representative on the board of directors, which means that it can participate in the key policy making process. And in this case, Banana holds 40% and can appoint 1 out of 5 directors. It shows that it has significant influence but not control, because only 1 director out of 5, he cannot control the composition of the board of directors. However, it is represented by at least 1 director. And therefore, we have to equity account for it up to the point when significant influence is lost. And the cost will be 18 million, which is the cost, plus the share of the 2.4 equity accounting. So at the time when we dispose it, the carrying value will be 20.4 million. So here is the answer for this 4 mark. Next, they are asking how the gain or loss of disposal of Strawberry should be recorded in the consolidated financial statement, and how the investment in Strawberry should be accounted for after the part disposal. So again, 4 marks asking 2 requirements. One is how to get the gain or loss on disposal. Secondly is after partial disposal, what will be the investment in Strawberry? How should it be treated? Now let's go back in the question and look again. On the 1st October 2016, Banana sold 75% of the 40% shareholding. In other words, the total shareholding dropped from 40% to 10%, and therefore it lost its right to appoint director. Fair value of the remaining 10% was 4.5 million at the time of disposal, and it dropped to 4 million by year end. And the parent company has no intention to sell the 10% shareholdings and elected to stay it at fair value through OCI. Given its 10% is no longer have the significant influence, and you also have lost the right to appoint director, so no longer have the significant influence, therefore it is not associated company. It will become a financial instrument, and it is fair value through OCI. Actually, the answer was already stated in the question, so it's so straightforward. And we understand that this fair value through OCI has to be stayed at fair value and subsequently remeasured to the fair value at year end. Now you record a loss in the reserve of 14 million, which we know that how to calculate 14. They use the cost of purchase 18 million less the fair value at year end, which pretty sure is not correct, because we know that at the time it has not considered the sales proceeds. So how should the answer calculated? Maybe we can consider it using a layman concept, say using a cash-in, cash-out approach. Back in several years ago, how much you pay to acquire the company? We pay 18 million to acquire an associate company. All right, you cash out 18 million. What you got now? You got now a fair value for OCI 4.5 million asset, and you also got cash 19 million. All right, so you pay 18 million, and now you got two pieces of asset. One is cash 19, the other is 4.5. All right, so by just looking at, we already know that I have a cash and I have an OCI asset. At the same time, I give up and I sold. Therefore, by just looking at this picture, you understand that there should be a gain of 5.5 million. There shouldn't be any loss. What should be the entry? The entry is actually staring at you. By just looking at this picture, you should debit bank 19 million, debit financial instrument fair value for OCI, and you wipe away the investment in sold 18 million. So the total gain recognized in the profit and loss account should be 5.5. So what should be the entry? What should be the entry? So now I just show the entry exactly equal to the chart. You debit bank 90 million, debit fair value financial instrument 4.5. You give up the cost of investment in the associate company 18 million. And I understand that in total I should recognize a 5.5 gain. However, remember that during the days when the Strawberry was an associate company, we have already reported 2.4 as the shares of profit in the part 1. Therefore now, we should only recognize the balance 3.1 million as a gain or loss on disposal. Because in total, this whole transaction, I should only have the maximum gain of 5.5. So this will be a very important entry. All right, I wish you understand it, and it's pretty straightforward. Once you get it, then many questions you can apply this entry and get the marks. But of course, in order to gain more marks, I also would like to show the calculation here. Now, the 40% shareholding, how should I sell it? 30% I sold it, and immediately I pocket cash 19, and the remaining 10% I haven't sold it, but if I sell it, I'm able to get 1.5. All right, so this is the asset. One is I already received, the other is receivable should I want to sell it and receive it. And less the carrying value at the time of disposal, which is equal to the cost 18 million plus the share of the sold profit 2.4. All right, this 20.4 is actually the answer in part 1. So the total gain on disposal this time is 3.1. So you can conclude that this question, or you comment that the holding company is incorrect to recognize a loss in the reserve of 40 million, this should be reversed. Instead, a gain of 3.1 should be recognized in the P&L. And the accounting treatment of the remaining 10% of the strawberry should be treated as financial instrument, stay at fair value for OCI, and initially you should be recognized at the cost of the fair value at that time of 4.5. And subsequently, by year end, because the price dropped, therefore we have a remeasured to the fair value of 4 million, with 0.5 taken to the OCI, all right, a debit to the OCI. So that is my sharing of this question. I wish that you find it helpful. All right, I will share with you other papers in future. Thank you for listening.